Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business so you don't have to. Today we are looking at a filing from Fidelity New York Municipal Trust 2, and it's got some twists. We'll uncover where your money went, what the fund is investing in, and the hidden risks that could make or break your returns, all using simple English. Buckle up. This report is basically a checkup on the Fidelity New York Municipal Money Market Fund. It's letting shareholders know how things went from February of last year through January of this year. We will find out about the fund's investments, how much it costs to run, and if anything big changed. First, let's talk about costs. Everyone wants to know how much they're paying in fees. For the Fidelity New York Municipal Money Market Fund, it cost $43 for every $10,000 invested last year. In percentage terms, that's 0.42%. This means that if you had $10,000 in the fund, almost 0.5% went to expenses. Now, how big is this fund anyway? As of the end of January, it was over $422 billion. That's a lot of money, and it was spread across 94 different investments. The advisory firm, the company that manages the fund, got paid almost $8 million to manage it. What did the fund actually invest in? The report breaks it down. Most of the money, over 80%, is in investments that mature very quickly in just 1 to 7 days. That means the fund is keeping things pretty liquid, meaning easy to turn back into cash. Digging into the types of investments, almost half are in something called variable rate demand notes, or VRDNs. A little over a quarter is in tender option bonds, and almost 17% is in municipal securities. Only a small percentage, around 3%, is in commercial paper. Has anything changed recently? Yes, but nothing to get too worked up about. The report mentions that they updated the fund's principal investment risks to align with rule changes from the Securities and Exchange Commission related to money market funds. This doesn't mean a complete revamp, it's more of a tweaking of the language they use to describe the risks. Moving on, the fund also names an audit committee financial expert. This is Laura Bishop, and it's basically their go-to person who makes sure the numbers add up and everything is financially sound. She is independent. And what they mean by that is that she does not own parts of the company. How much did the auditors cost? The company that checked the fund's books, Deloitte, charged about $31,300 for the audit, plus another $5,900 for tax services and $700 for other fees. Seems reasonable given the fund's size. On top of that, the audit committee pre-approves all services. The report also includes financial statements for different classes or share types within the fund, each with slightly different costs. For example, the institutional class had expenses of just $20 per $10,000 invested, which translates to an expense ratio of 0.20 tons per se. Also had a key fact section. Let's take a quick peek at the statement of assets and liabilities. The fund's investments are valued at over $4.2 billion. On the other side, they have to pay some bills. Those liabilities are around $23 million. So subtracting what they owe from what they own leaves them with the net assets, which are over $4.2 billion. They also show how they calculate the net asset value per share, the NIV, for each class of the fund. In this case, it's $1 a share. Moving to the statement of operations, we see how the fund made money. They earned over $130 million in income, mostly from interest on their investments, about $117 million specifically. After subtracting expenses of around $9.5 million, the fund's net investment income was just over $120 million. The gain on investments was not a lot, so we will skip it. The important thing is that the net increase in the fund's assets was $120 million. The gain on investments was not a lot, so we will skip it. The important thing is that the net increase in the fund's assets was $120 million. The gain on investments was not a lot, so we will skip it. The important thing is that the net increase in the fund's assets was $120 million. The old Olsen firm's net investment income was just over $120 million, and the gain on investments was not a lot, so we will skip it. The important thing is that the net increase in the fund's assets was $120 million. The gain on investments was not a lot, so we will skip it. The important thing is that the net increase in the fund's assets was $120 million. The statement of changes in net assets puts it all together. They started the year with about $333 billion. From operations, paid out about $120 million from operations, paid out about $120 million in distributions, and then saw a net increase from people buying and selling shares. So after all that, they ended the year with over $4.2 billion in net assets. The financial highlights provide a year-by-year comparison. The net asset value is almost always $1, and that's a good sign of stability, so we will mostly skip that as well. What's more important is what they call a total return, which was under 3% in any of the years. This is not too exciting, but also relatively stable. That number is better to use for investment strategies. Next to return, expenses are most important. You can see them trending up as well, so the investors are paying more to keep them safe. There are also some notes included in the report that are less relevant for the majority of retail customers, but let's take a quick peek. All investments are categorized as level 2 under the fair value hierarchy. The inputs or methodology used for valuing securities may not be an indication of the risk associated with investing in these securities. There is also a list of fees for affiliates, with the most relevant one being 2% for average net assets for management fees for FMR. It is also important to note that there are some sub-advisory agreements. The board, which include the independent trustees, review Fidelity's staffing, resources, performance data, and any changes. The board reviews and takes into consideration various sources, but not one source of review seems to be more prominent than others. After the reviews, the board seems to approve a renegotiation. Lastly, Deloitte confirmed, as they do every year, to NT. Now, what's my take on all of this based on these results? Fidelity New York Municipal Money Market Fund appears to be a steady but not super exciting investment. The fund's focus on short-term maturities makes it a safe bet, while the returns aren't going to knock your socks off. The low expense ratios, especially for the institutional class and its size, indicate efficiency. One potential downside is the fund's reliance on certain types of securities like VRDNs and tender option bonds. If something goes wrong in that market, it could affect the fund. For example, they are subject to an assessment event, meaning that depending on factors that are hard to predict, they may be subject to assessment charges. Overall, this fund seems like a reasonable choice for people who want a safe place to park their cash, especially if you are interested in municipal market investments. I would consider it a safe investment, but the returns are also safe and therefore low. Thanks for watching. If you found this breakdown helpful, be sure to like, comment, and subscribe.